Alright, thank you for coming to watch my video on assignment 10-12A. Alright, so first we're given some information about a piece of equipment that we're purchasing for $425,000, which we purchased with a $42,500 down payment. Basically, that information is useless because take the $425,000, subtract the $42,000, and you get the $382,500, which is the mortgage payable that we're going to be using. Alright, so we're going to take that $382,500 and put it over here in our principal balance of the issue date, because that's what we gave as payment for this piece of equipment on the day that we purchased it. Okay, so then we also have a 7% interest rate over 5 years, and we're going to be paying $93,288 on December 1st or December 31st of every year over those 5 years. So for the first thing we're going to need to do after we put in the principal balance is for each year the cash payment is going to be $93,288. So the first year, second year, third year, and so on. All these years are going to be the $93,288. Okay, then to get our interest expense, we're going to take our principal balance and multiply that by our interest rate up here, which is going to give us that $26,775, and that's going to be our interest expense for the year. And then we're going to take our cash payment and subtract the interest, which will give us the reduction of the principal. So it's basically our principal payment for the year, and that's right here. So that gives us $66,513 right there. And then we're going to take the principal balance, the $382,000, and subtract the $66,513 to give us the $315,987. And if you want to see that, that math is right here. Okay, then we're just going to keep this short. I'm going to do the second year and then do a little explaining, and then we're going to move on. Okay, so the second year, we're going to take that 315,987, multiply that by the 7% to give us that 22,119. That is going to give us a decimal here, but because it isn't significant, we're just going to truncate that as the question asks that we round to 0 decimals. Okay, then we take the cash payment minus the interest expense, and that gives us our principal payment of $71,169, and subtracting the principal balance minus the payment is going to be $244,818. Okay, so then basically continue that same process down all the way. Now in year 4, at least these are my numbers, I have $87,186 as my principal balance for the end of the year. Now my reduction of principal is $87,185, and that does leave me with a balance of $1. Now there is an asterisk here that says amount may be off due to rounding. So anytime that we've truncated any decimals, basically are negated right here. And so while technically the balance at the end of 5 years should be 0, due to our rounding with the question, we are left with $1 left to quote-unquote pay, even though it has been paid. So don't be afraid to put $1 or whatever amount it is when you subtract your final principal balance from the reduction of principal on year 5. Okay, moving on. Part B is going to be the journal entry for December 31st, which is the first year of this piece of equipment. So we're going to debit our interest expense for $26,775, which if we go back to the top of our amortization, the interest expense in the first year is going to give us $26,775. Okay, and then that leaves us with our mortgage payable of $66,513, and that's going to be our reduction in principal. And all of that together is going to give us our cash payment of $93,288 right there. And since we're paying the cash, we're crediting it and debiting the expense, increasing it, and the payable. Okay. All right, moving on to Part C. Part C is asking us to do a partial balance sheet for our liabilities section based on December 31st of 2017. Okay, so the first thing we're going to do is our current liabilities, and we are going to have a mortgage payable here, and then our long-term liabilities underneath that, also with the mortgage payable, and then underneath that is our total liabilities. Now the numbers on this section I wasn't too sure on. The 66,513, which, if you remember from Part B, is the mortgage payable for December 31st. That's what I thought would go there. Obviously, I'm wrong, and I guess I didn't understand it. So if y'all could help me out with that, that would be great. But thank you for watching my video.